Good morning, ladies and gentlemen. Let me first introduce myself. My name is Phil Riches. I'm the Sales Director for Keystone Property Finance. I thank you for joining the presentation today, which has been kindly hosted through the L&G Mortgage Club. Over the next 30 minutes or so, I want to discuss product transfers and how important they will be to both you, your client, and to lenders. And during this presentation, I want to cover the following. I want to review interest rates from 2022. I want to look at business volumes in 2023 and the UK finance forecast for 2024. How the rise in interest rates has affected ICRs and maximum lending available. I want to discuss product transfers and Keystone and how we've achieved this when other lenders have not been able to do so. Who else offers product transfers? Product transfer evolution. Watch this space. There is a poll that I will come to when I get to the slide, which I'd ask you to take part in. And lastly, just to go through some remortgaging opportunities and remortgaging with Keystone. So, ladies and gentlemen, without further ado, let's have a discussion. Let's have a review in terms of the market and where we are. On the slide at the moment, you've got the interest rates starting from February 2022, when many of you will remember rates were at the lowest levels for any time that I can remember in the past 20 to 30 years. However, things became tough for landlords, and they became tough like everybody else was caught off guard by the speed and ferocity with which the Bank of England decided to hike interest rates from September 2022 or before that up until the end of last year. Within a 20-month period, we saw interest rates increase 14 times in 20 months, unheard of and culminating in the most aggressive tightening cycle in decades. Unsurprisingly, we have seen mortgage rates follow suit. And in Keystone alone, in 2023, we had to implement over 24 product changes due both to the Bank of England rate rises and the volatility of swap rates, with mortgage costs in some instances doubling for landlords. And many of you as brokers will have been aware of this and will have wondered what was going on and how you could get your cases submitted as quickly as possible. Some landlords, with the interest rates having gone up, have been able to compensate the higher borrowing costs by increasing rent, but others have not been able to do so. And this has been a problem for landlords moving forward into the latter part of 2022 and throughout 2023. The higher rates have affected, or the higher interest rates have affected landlords' profits and their ability to get a mortgage in the first place. Due to this, we and other lenders have seen a spike in product transfer business over the last 18 months. And with interest rates at the present time still at 5.25% and unlikely to move for some period of time, it is likely that there will be a continued requirement for product transfer business into 2024 and beyond. So let's take a look at business volumes. Now, these figures have come from UK Finance, and they've recently been released. So in 2023, gross lending was £226 billion, down 28% on a year-on-year change from 2022. Lending for house purchase was £130 billion. That was down 23% on 2022. External remortgaging was only £65 billion. That was down 21% from 2022. Internal product transfers. This, however, increased to £219 billion and was up 11% from 2022. New buy-to-let purchases was only £8 billion in 2023 and was down 53% from 2022. With the final two parts of arrears at 105,600 cases, up 30% from 2022, and possessions or repossessions of 4,400 properties, up 13% from 2022. So you can see that 2023, although not as productive as you would have wanted and we would have wanted as a lender in terms of business, the one spike was internal product transfers. And this is what I want to talk to you about today. Let's look at the forecast from UK Finance for 2024. So what we've seen in terms of the forecast for 2024 is that their prediction is gross lending will fall by a further 5% to £215 billion. Lending for house purchase will fall by a further 8% to £120 billion. External remortgaging facility or external remortgage activity will fall by further 8% to £60 billion. They're predicting internal product transfers will fall by 8% to £202 billion. This, I believe, is overcooked, and I actually think will rise rather than will fall during 2024. The buy-to-let purchase market, they believe lending will fall by a further 13% to £7 billion. Arrears or numbers of arrears cases will increase to 128,800, they believe, by the end of 2024, and possessions or repossessions they believe will increase by 16% to 5,100. This would still see possessions lower than in any year from 2019 and all the way back to 1981 when the mortgage market was a little over half its current size. Having viewed these figures from UK Finance, we believe that these figures are undercooked and that they will be higher than are actually stated within the UK Finance facility. If, of course, we are fortunate enough to start getting rate reductions during the first quarter or second quarter of 2024, then I believe these figures will not be as extensively reduced as they are predicting at this present time. And as I say, product transfers will increase for many, many reasons. So let's take a look briefly in terms of ICRs. In terms of ICRs and how to make your transactions work in 2024, how have lenders assisted brokers and clients in 2023 and 2024? Many of you as brokers will go, we don't like lenders with high completion fees. And you will have seen a significant increase in completion fee products offered by most buy-to-let lenders throughout 2023 and into the start of 2024. There's been much discussion about why these products are necessary. As an example above, you can see clearly that by having to increase the completion fee, we have been able to reduce the rate and therefore enable the borrower to borrow more based upon a 2-year product. So as you can see from the example above, on a 2-year fixed product with a 2.5% completion fee, very close to those sorts of fees that were offered prior to the vast increase in rates, the client, either as an individual higher rate taxpayer, could borrow £262,000, or as a limited company or a lower rate taxpayer could borrow £304,000. If you look at a 2-year fix with a 4.5% fee, i.e. a lower rate, the same client as a higher rate taxpayer could borrow £304,000, or as a limited company or lower rate taxpayer could borrow £353,000. Why have I signified 2-year products instead of 5-year products? The reason being is 2-year products are still very popular with borrowers and with clients. And therefore, if they want to take a lower term fix with the basis that they believe they would be able to reduce their rates, assuming interest rates come down, then you need to make sure that the ICR stress test will work. So we've covered the market, we've covered ICRs. Now let's look at product transfers and the benefits of product transfers. What are the benefits of product transfers for both your clients and you as a broker? The client can get the security of a new fixed rate without having to go onto lender's SVR, which, as all of you will know, is expensive. The broker, you, will be paid a high proc fee through Keystone, better than the market average, for the work they complete on the product transfer, which is not onerous. What we pay, which is on this slide in front of you, you will find is what you would receive from a high street lender for a brand new case. So to that extent, the work that you need to do in terms of product transfers is not significant for either you or your client, and yet you will be paid for the work that you have completed with a reasonable sized proc fee. Keystone has found in the last year that product transfers have increased by nearly 1% throughout 2023, and overall has accounted for 4.5% of its overall lending. One of the problems that the market has is solving the conundrum in terms of product transfers when you are market rate funded, which is what Keystone is. The reason being that Keystone managed to solve it is that even though we're funded through the money markets and all of our lending is securitized, we have gone through the securitization basis and solved the conundrum of being able to offer product transfers, which many lenders within this market who are also money market funded are unable or have decided not to do so. Product transfers are an attractive proposition for landlords, as they are quick, convenient, and the affordability requirements are less onerous, which is very important when brokers and landlords think that they no longer meet lenders' criteria, especially in relation to ICRs. And finally, as an intermediary-only lender, Keystone will contact your client to advise them that their product is due for renewal, i.e. coming to the end of its fixed rate. But we will also advise you, the broker, when the PT is due. And it is down to you, the broker, to arrange and submit for the PT to take place. We as a lender do not contact your client and would not look to take this business in directly because we're not able to do so. In terms of the product transfers, you can see from the slide in front of you that we don't charge an application fee, we have no valuation fee, we don't charge legal fees, and in most instances we have a 1% arrangement fee which applies to all products, which can be added to the loan or paid up front. So we're offering a simple solution to product transfers within the buy-to-let market. Now let's look at other lenders that offer buy-to-let products within, especially within buy-to-let lenders. And here you will see I've given you mainstream lenders as well as specialist lenders. The reason I've given you mainstream lenders is that many of the mainstream lenders do offer buy-to-let products and do offer product transfers. Within the specialist market, up until recently, there were only 4 lenders that offered product transfers. They would have been Kent Reliance, Vida, Paragon Bank, and ourselves. 3 others have now joined the race. LendInvest very recently have started to offer product transfers. That is good news, especially for those brokers that have used LendInvest in terms of their products. Fleet very recently have launched their own product transfer facility. But note, this is only on the business that is now funded through Starling Bank and not business that was funded previously. And the mortgage lender, one of the new entrants to the market. If you're in a situation with mortgage lender, most of their products that have been sold have been 5-year products, and so would be able to, you would not be looking at doing a product transfer on the mortgage lender for at least another 2 to maybe 3 years. But they again do offer product transfers. However, PTs create challenges for lenders, as the lower fees make it more difficult to make the sums add up, even if there is far less work involved. The question is, will PTs remain a popular option among landlords in 2024? My view is yes, at least until the Bank of England starts to reduce interest rates to a point that remortgaging would then make sense. Most market observers believe the Bank of England will be forced to cut rates several times this year. However, as we have seen just recently, those cuts are not expected until the back end of this year, if at all, they do even arrive. And if they do arrive, they will be small and gradual. What we have seen over the past 2 to 3 weeks is swap rates being very volatile. They've gone down, they've gone up, they've gone down, and they've gone back up again. That is in relation to what is happening within the world at this present moment. So do take advantage to look for product transfers with the lender that you might be suggesting in relation to your client. This is where the poll comes into account, ladies and gentlemen. Product transfers, the evolution. The question I pose to you as a poll, and I would ask you just to answer either yes or no, is if a client could be offered a product transfer with additional borrowing, would that be of interest to both your client and you, the broker? I'd be interested to see what the poll says, because this is, in terms of product transfers, there has to be an evolution forward to try and help clients and brokers move forward without having to move lenders. Very recently, one of my senior business managers conducted a product transfer poll within the market. In the recent poll we conducted, 92% of intermediaries that responded to the poll said that product transfers were important to both their customers and to them as a broker. As I've said already, only a handful of specialist lenders offer a product transfer facility. And what you should be asking, or what you should be discussing with the BDMs of the lenders that don't offer product transfers, is why do they not offer it, and when will they be offering it? Because it is a situation that can be solved. As I've already demonstrated, Keystone solved this nearly 3.5 to 4 years ago. The reason, as I've said, that clients are very interested in these is that they can save money compared to remortgaging to another lender. They don't have costs for surveys or legals, and it can help customers where the case has been difficult to place and options for remortgaging are limited due to the recent interest rate rises, even though it may not fit the ICR calculations. So in terms of that, it's a case of you should seriously look at these when considering where your business is being placed or where you're thinking of a lender in relation to moving forward and putting your business into the market. However, if product transfer is not the option you want to go, I can tell you that in terms of remortgage, there are significant opportunities in the market in 2024. Over 55% of all buy-to-let lending that was completed and funded in 2018 was funded on 5-year products. So these maturities are now coming up, or have either come up to maturity or are coming up to maturity in 2024. Some of them will have happened in 2023, and clients will not have done anything because of the rates that were available during the latter part of 2023. So these remortgage opportunities will still be available and will have moved into the 2024 market. Clients also want to remortgage onto fixed rates to protect against, funnily enough, interest rate increases. So those that managed to take low rate fixes during 2018, 2019, 2020 will be sitting on good low fixes at the moment. But again, if they're unable to product transfer with their current lender, they will then be coming back to you to talk about where can they go and what can they do. Another reason that was coming fast has now gone down the slow lane, but might come back into fruition if we have a change of government, is the EPC changes. Landlords at some stage will have to bring their properties in line in case it then becomes illegal to rent a property with anything less than a C grade EPC rating. This has been shelved by the current government, but as I say, there is rumours that this may be reenacted by whoever takes charge in the country in the latter part of 2024. And last but not least, many landlords won't want to stay on high reversion rates with their current lender. The reason being these high reversion rates can be anywhere from 9 to 11%, and therefore can make servicing their loan very, very difficult. Let's look at Keystone Remortgages, just to give you an overview in terms of what is available in the market from ourselves. We can offer day one remortgages. What do we mean by a day one remortgage? Your client purchases a property today, they can remortgage it tomorrow. If they have done work to it, then they can remortgage it based against the purchase price of the property and the work that they have completed, or they can do it just purely against the purchase price. We can do remortgages to clear any bridging that has been put in place to either purchase the property, refurbish the property, or develop the property. We can remortgage to allow the client to replenish the savings they've used, again, either to do work on the property or to cover other costs that they have had to incur. It could well be that they've actually purchased or they want to convert a property under PDR, permitted development rights, from office to commercial, because the office unit or the shop with a flat above that they can split into two flats, they could take permitted development rights, take development finance, get the property into two residential properties, and then decide to refinance it. These are all part and parcel of what Keystone is able to lend on. We don't have a debt to income ratio, so personal indebtedness versus income won't affect our lending decision. So long as their credit conduct is in line with our policy, then we have no problem. Please note we lend on a gross basis, not on a net basis, which is a significant situation. And then on last note, there is no requirement for onward purchase details if the client is remortgaging to purchase another property. They can remortgage, hold the funds, and then decide to go to auction at a later stage. Last but not least, just to simplify complex buy-to-let. To give you an indication in terms of product transfers, we can offer these on any of what you see in front of you at the moment. So if the client has an HMO or a multi-unit freehold block, we can lend up to 15 units or occupants. If they took that and they wanted to do a product transfer, we will do a product transfer for them. If the client is an expat, has taken a mortgage from us and wants to then do a product transfer, we will similarly do that product transfer, be it a limited company or an individual. If they have remortgaged within the 6-month period and then have taken a short-term facility of 2 years and want to do a product transfer, again, we will do that. Complex limited company structures. What do I mean by this? Where a company owns a company and possibly owns the company that we're lending to. We can lend within that facility and we can discuss through with you whether that works or not. And lastly, if your client is looking to buy what I would term as ex-local authority flats, then we look for a minimum of 40% private ownership. As I've said at the beginning, and I shall say again, product transfers are available through all of these and are available for the clients to take part in and use when they come to the end of their mortgage term. Ladies and gentlemen, I've now come close to the end of my presentation. If you have any questions, please put them up. I see there's a couple of questions on the system at the moment. In terms of that, if you have any other questions, please contact myself. Please contact us on the number on the screen or email your inquiries or questions through to the inquiry box at Keystone, or visit our website and you will be able to understand what we're able to do. Ladies and gentlemen, thank you for your time and thank you for taking part in listening to myself in relation to product transfers. This is something that will not go away in the market and is something that you need to talk to your lenders that you use about. Thank you for your time. I'll now answer the questions that have come up, but thank you for your time.